Hi everyone, welcome to another episode of the Patient Wallet channel. Some stocks are getting crushed by the market and I bought into one of those which I'm very excited to talk about. Before we start, please like the video to help with the almighty YouTube algorithm and subscribe to the channel as I have some exciting videos coming out. Please note, all my videos are for educational purposes only and should not be taken as financial advice. Please do your own research before you take any financial decisions. Right, let's jump straight into the video. The stock I'm going to be talking about today is Adobe, ticker symbol ADBE. Probably most of you have used Adobe's products before, for example, a PDF, but Adobe is much more than a PDF. Their mission is to change the world through personalized digital experiences, and they offer many digital goods and services to serve creators and enterprises. From an investing perspective, Adobe is a subscription beast that is currently misunderstood by the market, in my opinion. There seems to be a narrative that AI is killing Adobe's business, and more broadly, we have seen this narrative expand to all SaaS businesses. The stock is down 21% year to date and down 41% from its 52-week high. So, I bought 4 shares of Adobe at an average cost of £260 or $353 per share. If you are interested in investing in Adobe, stay until the end as I filter through the noise and provide the key points that you need to be aware of. This company is trading at historically low valuations and I think has good potential to beat the benchmark. What I'll do, I'll go through the most recent earnings very quickly, look at Adobe's fundamentals and strategy, which is being questioned, and at the end, I'll summarize my investment thesis and share what returns I expect from current price levels. So Adobe's last earnings were a double beat on top and bottom line. They beat top line by $74 million and beat earnings per share by 2%. They also raised their guidance for the financial year 2025. Revenue guidance midpoint was raised from $23.4 billion to $23.6 billion and earnings per share from $15.8 to $16.3. Management also highlighted that their AI products are getting higher usage with Firefly app subscribers almost doubling quarter on quarter, and their business segments continue to grow at 11 and 10% year on year. They also reiterated that they are on track to meet the $250 million annual recurring revenue target from new AI products and went into many more details on how they are growing products and annual recurring revenue, but these were the key highlights. Jumping into fundamentals, revenue was up 11% year on year, digital media segment grew by 11% and digital experience by 10% year on year. These two segments account for 99% of Adobe's revenue, with the remaining 1% being publishing and advertising. This chart shows that revenue is consistently growing up and to the right over time. As I said at the beginning of the video, Adobe is a subscription beast with subscription type revenue being 95.7% of total revenue, increasing by 12% year on year and climbed from 93.2% of total revenue from Q2 2023. Remaining performance obligations were also up 10% year on year at $19.6 billion at the end of the quarter. Quarter on quarter, this was flat and below Q4 24, but I'm not too worried about that as the jump between Q3 and Q4 is larger than the past years, so I think this is part of normalization. Looking at margins, there is no evidence whatsoever of this business being disrupted here. Gross profit margins were at 89%, operating margin at 36%, and net income margin at 29%. Since Q1 23, all margins are up. The dip around Q1 2024 is the impact from paying Figma $1 billion after the acquisition attempt fell through, so they had to pay a breakup fee. I'll touch on this later, but I expect these margins to slowly creep up over time. Last one before I look into cash flows, diluted earnings per share was up 13% year on year at $3.94. For the last 12 months, EPS was $15.6, implying a price to earnings ratio of 22 times. Again, as with revenue, EPS over time moves up and to the right. On cash flows, I wanted to highlight two figures. Free cash flow per share excluding stock-based compensation grew 22% year on year, and looking at this at a trailing 12-month period, it grew 4.2% quarter on quarter and again is steadily moving up over the last few quarters. The last 12-month figure for the free cash flow excluding stock-based compensation is $17.2 per share, and at current prices implies a yield between 4.5 to 5%. In my opinion, this is a very cheap valuation for a company like Adobe, given their industry, their position, and the subscription nature of their business. Data shows that the business is doing fine, but the stock price keeps going down. Management is doing the right thing here and is buying back shares. They bought back 5% of the business in the last year alone and around 10% over the last 3 years. Share buybacks increased materially over the last couple of years, and at the moment, management is executing their $25 billion share buyback program announced last year. Last quarter alone, they spent $3.5 billion on share buybacks, and hopefully they will continue to do that as long as the stock remains low. So fundamentals are fine, it's a fact as we've seen. Why is the stock down? This is a market narrative, which I think it's wrong. What the market is basically saying, it's AI will kill Adobe's business. AI has been around for a few years now, and I think AI will help Adobe. Let me explain. If you want to understand how management thinks of Adobe, go and listen to their investor summit they did in Q1. It's more than 2 hours, so if you don't have the time, I'll share my takeaways here. This chart represents how Adobe thinks of the AI impact. Over time, due to AI and technological advancements, the creative output has increased. You have entertainment, gaming, brands, socials, business communications, and many more categories. The section on the right is how Adobe is positioning itself to capture this trend. For business professionals and consumers, they offer a freemium model and all-in-one solutions. In other words, get it done as seamlessly and as cheap as possible. For creative professionals, they want to allow creators to transform their thoughts into an output on all platforms. That's where Adobe image, video, and voice models, as well as third-party models come in, which are fully integrated under the Adobe ecosystem. Lastly, on marketing professionals, they want to offer custom and safe models, self-serve optionality, and integration of workflows and systems. They offer start-to-end solutions, allow for self-service if they want to, and ensure safety when using their models. So how is this approach playing out so far? On the right-hand side, you have the new AI-first products. These products are the Firefly app and services, Gen Studio, and Acrobat AI Assistant. At the start of FY24, annual recurring revenue was 0 for this category. In Q1 25, this increased to $125 million. It is on track to reach $250 million in annual recurring revenue by the end of this year. The section on the left is the existing portfolio. What happens when you layer AI across the existing Adobe products? You have new users and more usage, which in turn leads to 10% reduction in churn on Photoshop users using Gen Fill, and 10% increase in average revenue per user in Creative Cloud apps. Management estimates that this AI influenced annual recurring revenue was $3.5 billion as at the end of FY24. So, this is how management is thinking about AI and AI integration. As of today, new products are driving distinct new revenues, but at the same time enhance the value proposition for existing products, which help with pricing and churn. In other words, Adobe management is making it so that there is no point in moving away from their products. Instead, they brought in new AI products and layered AI across their portfolio. This means new users will be attracted to the ecosystem and existing users have no reason to leave Adobe. It's very similar to the argument I made about Google versus ChatGPT in my last week's video, so go and check that out. We went over the market narrative, fundamentals, and Adobe strategy. I summarize my investment thesis as follows. Number 1, market narrative is wrong. Fundamentals show Adobe's business is growing and is profitable. Number 2, Adobe's AI strategy is the correct approach. Add new AI products for new revenue and layer AI to existing products to improve value proposition. A clear differentiator here is the fact that Adobe's models were trained on licensed data, which means users can feel safe using their models and will avoid the situation between Disney and Universal suing Midjourney over image generation. If you are a user, you want to be sure that anything you use on their platform will not lead to a lawsuit down the line. Number 3, margins will expand in the medium to long term because as SaaS businesses scale, profitability expands. More AI features help with the value proposition, which in turn helps with pricing power, and computational costs will come down over time as new technology advancements come online and due to optimizations. And lastly, number 4, the free cash flow yield excluding stock-based compensation is at very cheap levels at 4.5 to 5%. I have not seen a company with such high level of subscription type revenue trade at these levels. The cherry on top is that management continues the aggressive buybacks and is a good capital allocation practice at these price levels. The stock is trading at levels we've not seen since early 2020. Once the market realizes all of this, they will re-rate the company, and I expect a double from here over the next few years. That's my opinion. I cannot predict the future, so let's see what happens. Let me know where you think Adobe's stock price goes from here in the comments below. That's it for this episode. If you're still watching, thank you. Give the video a like and subscribe, and I'll see you in the next one.